who couldn't make it get the recording. As usual, we will upload this into our YouTube channel, so you can check any specific details afterwards. And please don't hesitate to ask any questions as we go along. It's always a pleasure to clarify those if I know how to, hopefully. So the purpose of today's webinar is to explain the concept of Darwin investable attributes. It's one of the things that sets us apart within DarwinX from any other so-called social trading providers, or whatever you want to call it. And today's agenda will cover why we analyze the investable attributes. In a nutshell, which is essentially our answer on how to tell a consistent from a lucky trader, and hopefully I'll convince you today that we've got a sound approach, which is also validated by the numbers. And then once we've gone through the philosophy of the whole thing, we'll give you a more of a detailed look into the 12 investable attributes. As we do so, I appreciate there'll be stuff that is unclear, so please do not hesitate to let me know. It may be that we can cover this as we go along, or we're now doing a significant boost into our content production. So there's more and more coming to explain all these questions, and we'll make sure to program either blog posts or webinars to get everybody up to speed. And last but not least, I'll share some use cases on how to use the existing functionality to build and invest a portfolio out of the Darwin asset class. All right. So let's get going on the first element of the agenda. It's why even come up with investable attributes. Well, let's start at the high level. I mean, there's numbers that I'll share, which I think will be quite interesting to you guys. And there's more and more people who trade the markets from home. We've done some research, and there's 6 million people worldwide who trade pretty much, with a significant degree of commitment, more than 20 trades a month. And the numbers keep growing. So the 6 million now has grown up from pretty much nothing in 2005, with a growth rate of more than 10% per year. So at that rate, the numbers are expected to double in the next 5 years. So it's a significant number of traders that are out there that, if you believe in evolution, like some of those guys will eventually grow through the motions and learn how to make money. And we think that's an asset worth listing, that we list for everyone's benefit. So our mission as a company is to be the marketplace where all traders choose to list their strategy for their and investor benefit. However, there's a catch. So whilst we do think this is an asset in the making, we also know that good traders are few and far between, but every trader will promise an investor that he's very, very good. So how do you tell the guy who knows what he's doing from the guy who doesn't? Because returns yesterday, as you know, do not translate into returns tomorrow. And that's kind of the gist of what we do, not because we're very, very good guys or like to do the right thing, but because it's actually a business model. Because we are a DMA broker that never makes money when customers lose money, what we've got here is a framework where we need the traders to do well. So that's why we offer a good broker, and all the diagnostics we'll discuss. But we also need the investors to find the best traders and give them the most capital, because that's what makes our business grow in alignment with both the traders and the investors. So for us, the investable attributes are far more than interesting exercise. It's actually the make or break for the success of our company, and this is a key thing. I can't really stress it enough. So and this also points towards the evolution of what we do. So the investable attributes, they keep getting better and better. We need them to become better and better, and they are now far better than they were this time last year, and they will be far better next year than they are right now, because it's part of what we, what makes our success as a company. We're all on the same boat, and I can't stress how important that is for the success of both traders and investors. Now, the question is, okay, so we said, how do we tell a good trader from a lucky punter? And the answer is to look for the process. So how did the trader generate the returns? more than look at the outcome. So whether the trader actually made or didn't make money is kind of secondary in this whole thing, because we're looking at the how instead of the what. Why? Well, because once you've looked at the what, if you think that the what is sound, only then do you start looking for the winners, because you know then that the people who have done things in a consistent way and are making money, those are the good traders. So making money is a necessary but not sufficient condition for being a good trader, and that's why we look at the skill side of things only instead of the return side of things. To put to cut a long story short, luck fades. So being lucky in the past does not guarantee that you will be lucky in the future, but being skilled in the past does guarantee that you will remain skilled in the future. And at the very least, you may stop to make money, but you will only do that so gradually, and there will be time for the investor to switch from a strategy that is not working in the current market conditions into other investable strategies that are working in the current market conditions. And that's another important point. So this is not just about investing, it's also about actively managing a trader portfolio and being able to pick the winners as and when the market conditions suit them. So far, so good. Any questions, disagreements? Okay, sounds like we're good. So let's keep going. What does this mean, analyzing the process instead of the outcome? Well, what we do is analyze every strategy for 12 investable attributes that we grade from 0 to 10. The attributes you can see here in this table, and I'm also now going to switch into the user interface. So can you guys confirm that you see my Google browser now instead of the PowerPoint presentation? Perfect. Well, thanks, Ralph, for all the help. I really appreciate it. Right. So you see from left to right all the 12 elements that are here. The whole thing is clickable. So if you want to find out more about, say, one of them, you click on the thing, and it takes you to the facts that lead us to give a grade of, say, in this case, 5.1 out of 10 for open strategy. And also important, the whole interface is quite scrollable up and down. So in some cases, there's quite a bunch of information further down the thing, that people don't really notice. So you should know that, when you click in the thing, feel free to scroll up and down, because there may be more underneath, with this back to top is showing it. And also, very importantly, we not only give you the 5.1 grade that the strategy has got right now, but we also give you the evolution of the strategy over the last full-time months in the market. So you can click on the last 3 months, or the last 6 months, full-time months, or the last 12 months in the market. And see, for instance, in this case, you can see that the open strategy seems to be steadily increasing over time, which is not necessarily a bad sign. So every bit helps. Even though the grade isn't great, it's still getting better. I'll get back into what open strategy means, but I wanted to cover that for basics. Now, you can not only access the stuff from the grades, you can also click on any of these tabs or these tabs to see the stuff. Since we're talking about the investable attributes, we've got this hierarchy of high-level investable attributes, and then this breaks up into a bunch of other stuff. I can even, for instance, monitor the evolution of the Darwin X score grade over time and plot it against any or all of the other elements. Okay, so yeah, I could get to a point where I can click how all the grades are doing over time. Okay. So that's there. But then you're wondering, okay, I don't know what these things are, so let's get back to the presentation and start explaining. Okay. The first sort of category of elements is experience. So how do we know? Because all we're analyzing here is the track record. So how do we know if a trader's track record has enough information for us to form our own opinion about whether we should invest in him or not? Okay. Well, there's 2 attributes we've got to track that. The first one is what we call EX, for experience. Experience is different from the others in that it can only grow. So everybody starts at 0, everybody grows towards 10, and once you have grown to 10, you never go back. So it is time and trades will eventually take us to a grade of 10 out of 10, because at some point we will have enough information. I'm not going to go into the mathematical details of this, but what we're looking for is statistical significance in a way such that people cannot do 3,000 trades in a single asset at the same time to give the impression that they have tons of trades under the belt. Because if you do 3,000 trades in the euro dollar in one day, what you've done is you've traded the euro dollar for a day, and that is not 3,000 trades. That's just one single trade. So I'm not going to go into the details of that, but it's all designed to make sure that no one can fool the investor by playing tricks. Okay, now, and that brings me to the second element of the investable attributes, which is the MC, market correlation. So how do I know if a strategy is investable? Well, part of this is to understand just in what assets does the trader invest. So for instance, it could be I'm a gold trader, and gold has had a very long run of winning, because it's been a bull market for gold, and I've happened to be long more often than I've been short. And the reason, and I'm winning not because my trading strategy is any good, but because I've just been lucky in kind of being long randomly in a bull market. So now that's not necessarily bad, but of course an investor should know that whenever, say, the market goes south instead of going north, the strategy is very likely going to go south as well. So we track the correlation of a strategy to the individual elements that are in it. I'm just going to click into the detailed market correlation chart so you can see what I mean by that. So you've seen I've clicked on market correlation. We go into the investable attributes market correlation tab, and I can start seeing in what assets the trader was positioned. So it's cable, Canadian dollar, where he's always been short, as you can see here. This is kind of 50-50 and so on and so forth. And we've got a summary for all this, which is telling us, well, no, the trader is as likely to be long or short in the assets that he trades in a way such that he has no correlation to the other assets, so that I know that traditional markets may do whatever they do. My trader is not more likely to win because the market is going up than he is to lose because the market is going down, because it's just not correlated. He's created a new asset by trading long and short in the market, and that's part of experience, because that's adding more information here. So there's a question here of whether the attributes are all given the same weight, and the answer is, at this point, I think not all of them are given the same weight, but most of them are. So we haven't really fiddled with creating a very detailed weighting system, because maybe I should have said that in advance. So the core summary of what all that I'll tell you is that we analyze 12 attributes that are all independent to each other, so that we can produce a single score from 0 to 100, which is quite predictive and is much more predictive than any of the individual attributes taken by themselves. So if there's one thing I could tell you about this whole thing, is I want you to understand that everything is done in a way that's kind of quite robust. But if anything, you should only be looking at the D-score as the summary statistic, and that's the one that has the most predictive power of all of them, precisely because it combines all the information that all of them bring. Okay. Okay, so we've covered experience. Now we get into the point of risk management, and this is a point where this is more of a trader-oriented thing. Not that a bad risk management is going to hit you as an investor, but what we're doing here is analyzing whether the trader more or less roughly holds his risk constant, both over time and across positions. Why is that important? Well, let's do a thought experiment. If I take 100 trades, and one of the trades I do with 100 times more leverage than on the other 99, then the outcome of my strategy, whether good or bad, is going to be driven completely by the outcome of that single individual trade. And I will not be able to take any conclusions on whether the strategy is any good, because ultimately this is just about whether that trade won or lost. Compare that with a strategy that is both constant in risk taking across individual positions, so all 100 positions risk about the same, and over time. So the 100 positions that I took this month are equally similarly risky to the ones I'll take next month and to the one to the one 6 months ago. Now, if that's the case, then I know that if the strategy is winning or losing, it's because on average the trades are winning or losing, not because one single trade was a lucky hit or an unlucky hit. Okay, so that's what we measure on the risk management side of things. And then we get on to, so I'll come back to the list. You've seen experience, which is made up of EX and market correlation. Then there's risk management, which is risk stability and risk adjustment. And then we go into the two that are made up of timing. Okay, so on timing, what do we do? Well, why does a trader enter the market? Well, because he thinks it's going to go his way. Otherwise, why go into it, right? Or why does a trader exit the market? Well, because he thinks it's going to go against him thereafter. Otherwise, why leave it, right? Well, you can measure that because you can basically say, well, what would have happened, say, for my open timing, what would have happened if I had systematically opened my trades earlier than I opened my trades? Would I have done better than I did? How do I compare that? Well, what we're doing here is for all the trades that we're doing, comparing how the strategy fared against strategies that entered the market earlier that you can find with a minus relative to the duration of the position. So if I take a trade for 100 minutes, minus 30% is tracking how I would have done by entering, say, 30 minutes before I entered the trades. Okay. Now, similarly, 50% is saying what would have happened if I had entered the trades 50 minutes into my 100-minute trade, if I had entered a lot later. And you can see that if my strategy is really entering at the optimum point, it should beat over time all the alternative strategies that go in or out, that go in earlier or later. And I can also track how this evolves over time. Is my strategy getting better or worse? I can click, say, let's just go into the interface so you can see the curves. So I've got my strategy, which is this strategy at the bottom. And this is telling me that all the alternatives would have been better in this case. Right? So I'm seeing actually no, I'm seeing how this one compares with all the others. So I see, for instance, that minus 40% has the best ranking. So all other things equal, for the last 12 periods, entering significantly earlier into my trades would have resulted in a better outcome. Does that make sense? And similarly, if we scroll down to the bottom, we can do the same thing for exiting the strategy. So I can see how it would have fared if I'd done much worse. And as you can see, this strategy, which is actually a pretty good strategy, it scores badly on both opening and close. Why? Because it actually only just enters the market shortly ahead of a news release. So it's actually kind of quite, it doesn't really pick when it opens the market. It goes into the market. It actually goes into the market when there's a news release. Okay. You can compare with other strategies for your information. Okay, so we've covered the timing bit here. Any questions on timing so far? No? Looks like we're good. So let's keep going. So go back to the interface, sorry, to the presentation, and we see, well, the element of consistency and discipline. So all other things being equal, does the strategy stick to a pattern or not? And when I mean a pattern, I mean a pattern in positive returns or negative returns, or in duration. So does it always say enter the market for, say, half an hour? So we'll go back to the interface now and see it. And last but not least, is there any evidence of loss aversion? So let's look at the interface, because it all comes clearer to mind when we look into it. Start with positive return consistency. Well, we've got 6.4 out of 10. And what we're plotting here is normalized pip returns for every position in green when it's positive, in red when it's a losing trade. You see the trades at the bottom, the pips at the bottom, against the duration of it. And we see that, roughly speaking, it more or less is scattered with it a reasonably defined range of up to 64 pips. So overall, it's giving a grade for the positive returns of, we can see here on the left-hand side, 6.5. Why? Well, because there's quite a bit of scattering. We have some stuff here in between 2 and 4 pips, and then it's kind of a bit open. So it's not getting full 10 out of 10 because there's some scattering, but at least we see some resemblance of a pattern by eyeballing this. And similarly, when we go for the negative returns, we actually see more of a pattern because the dispersion is lower. So there's no trade that close at worse than 16 pips, which is less than the discrepancy on the right-hand side. So it's getting better grade for negative return consistency than it's getting for positive, and you can judge for yourself which one you think is better. And similarly, if we look at the same chart but focus not on the left to right but top to bottom, we actually see that it's actually quite rare for the strategy to be in the market longer than, say, half an hour, and as a result of that, it's being granted a high score for duration consistency, which has been improving recently. So it used to go down to kind of 6.5, and now it's back up to reasonably 8. Very important, the evolution of the attributes is as powerful as the snapshot at any point in time, and can be actually an early warning of stuff that's starting to go south. Okay. Any questions? No, it looks like we're good. Then we look into loss aversion. So the loss aversion we haven't really covered. What we're plotting here is the favorable and adverse excursions per position. So if we look at focus on one individual VAR, what this is telling us in this position on the Canadian versus US dollar, the trader got to make a maximum profit of 10.6% of equity. It was not once in the red, so you can see there's no red bar for this one. So the minimum it had was 0% return on open, and it was closed at a profit of 9.9. And you can see there's a little black bar at the top, which is the close bar, and this is one of the rare strategies that has bigger favorable excursions than it has adverse excursions, and that's actually why it's getting a 10, which is a very, very rare thing for a strategy to have, and a pretty good one as well. So it's quite consistent. You will not be negatively surprised by this particular strategy. And coming back to the interface, to the presentation, we see the last of the elements, which is capacity. In capacity, what we're trying to track is how much AUM, assets under management, or investor capital, will the strategy be able to accept before the returns start fading. Why would returns start fading? Well, because if you only manage, say, £100,000, then you're not really hitting the market in the slightest. But when you go to the market with, say, 100 million, then you're going to move it by a couple of pips, and that will eat into your profitability, which is ultimately what limits your capacity. And in this case, as we see, it's a very profitable strategy with pretty good grades, but it looks as though it will never scale above, it's probably approaching full capacity already as it is right now, and that's what we're tracking here. Okay, this is relevant because then there's a divergence at times. Now, what's the best thing about all these things is that they are uncorrelated to each other, and they can be summarized into the 0 to 100 score that is actually quite predictive. So these 12 elements can be combined into a single thing, and whilst the individual elements are measuring things that are too detailed for us to draw any overall conclusions, after having looked at 12 things that are all independent from each other and all independent from the level of risk, we've got a pretty good way to start delving down into the Darwin universe and start looking at just the guys that are likely to make money in the future. So if we think of what we're playing here, is we're playing a game where there's a haystack with, say, 1,500 Darwins and more all the time, where we need to find a way to zoom into the 20, 30, 40 that are worth our time looking into. I'm not saying investing into. It's just the short list that brings us from 1,300 strategies to say 40 without any effort, and that's what the D-score does best. Okay. So how would we go about investing in Darwin's? Well, you can't really rigorously analyze 1,500 Darwin. So you need some sort of filter criteria to get down from 1,500 to say 50. And then within those 50, there'll be 20, 30 that we're not really interested in anyways, even if they have a high score, because for whatever reasons, they just don't suit us. So we will only ever track a track more closely a sub portion of all that. Say we're down from 50 down to kind of 520 Darwins that we're intimately familiar with. And then we really will only back investing into, say, 3, and probably 1 is too little because you're just too dependent on how that one guy is doing. But you can build reasonable portfolios with 3 to 4 very solid Darwins that you know. And if you're feeling more adventurous, then you could kind of actually think of investing in up to 10 of them that you really know inside out. And then once you've kind of narrowed down from the 1,500 to the 3 or 10 that you really know inside out, which is pretty much like your football team, then that team you actually actively manage. You can invest into them, you can invest out of them, you can even trade them at times. So there's people who actually wait for traders to be in a drawdown and double down at those points to get there. That's basically the sort of process that you can play with by using the tools that are at your disposal. Okay, I'm not sure if you guys are familiar with the concept of the filters and so on. If you want, I can go through those to show you how it all works. There's some pre-filters that you can see in the interface that are already predefined. So I can go at the Explore, starting from the Explore section. Looks like I've got some issues with my internet. Hang on. So I go to the Explore section and I can see there are some ready-made filters where I can really go say, like, show me the top 20 traders in the platform by assets under management. So here we go. Found them already, and that kind of narrows down my search significantly because I know I'm already standing on the shoulders of all the rest of the community. These are the top 20 guys according to the rest of the community, so I'll just only look at these. I'm saving myself my time. And then within these guys, then I basically say, I'm just going to drag by drawdown, and I say, 31% drawdown, 20. That's way too much for me. So I'll just only really look at the guys that have 10 or less. So I can basically say I'll just favorite all these guys, and after favorited them, I've got them here in my favorites filter. So I can find them again, and I've gradually built my team of, say, 14 guys that I'm willing to track more closely. And within those 14 guys, and I can play further. I can actually just say, well, the ones that have the highest return in the period, and so on and so forth. And gradually, as I said, I've filtered down from 1,200 to the guys that I really know. I'll eventually put them into my portfolio, and I can start kind of managing more in depth or less in depth. Okay. So there's a question of whether investors have an impact on D-score, and the answer is no. So at this point, the D-score is independent of the number of investors. But of course, you can use the D-score and the number of investors for increased for filtering. So you can say I could filter for has more than 50 investors and a D-score of 60, and that will help me get there faster. Any more questions? Okay. Yeah, so basically that's the more or less intro version of the individual investable attributes. So my core takeaway of today is basically what we've looked at is we've looked at how the trader trades instead of what returns he obtained, to narrow down from every possible strategy where we don't want to invest into the ones that are not only winning, but winning with a certain amount of proven skill underneath, which is far more likely to make money. Which are traders that are far more likely to make money tomorrow than traders who simply made money yesterday. And that's actually a way to get there. Right, so that was pretty much the agenda for today. Unless you have any extra questions on any individual elements that you want me to go over again, I can both related to this individual bit or the more general DARWIN platform. Do let me know now, or we can then defer for the next webinars. As on a side note, we are significantly beefing up our investments into content production that amounts to both blog posts and webinars. So you can expect far more clarification coming from us in the coming months. And also we appreciate this is not easy to digest as a content. So we're now investing into our own proprietary university to teach these things gradually and hopefully get more and better informed investors, which is good for us, for the traders, and for everyone else. Okay. So yeah, it looks as though we've covered all the questions. So I'm just going to check. I think there's one more that's come through, or maybe it's a thank you note. Yes, so the last point was another piece of news, and that is that we've just released conditional orders as part of the platform. So you'll now be able to trade, trade Darwins with buy limit or sell Darwins with different order types. So it's basically we've now gone more and more into making this a full-blown asset, so that you can set your own take profits and stop losses and have the additional safeguard of those on top of the built-in risk manager that comes in with all the Darwins. Okay, so that's kind of the good news for today. So I hope you guys like it. And if you think this was useful and want some more, you can of course sign up for the webinars next week, where we're talking. I think we're tackling the conditional orders. So we'll explain all there is to be explained about the conditional orders. So thank you so much for showing up and all the questions. I think the conditional orders were one of the last missing obvious gaps in the functionality. There'll be more surprises coming towards the end of the year, but I can very confidently promise that by the end of this year, I think we'll have an exchange with all the things you'd expect from any other asset class. You'll be able to buy and sell the guys. You'll be able to do fundamental analysis on them, and then you'll also be able to do even trading on them with more and more stuff that's on the pipeline, including the possibility of, for instance, backtesting the investment strategies. So stay with us. It takes time, but we'll all get there. And actually things are growing quite a bit. I think it's amazing to say that with assets under management by investors have sextupled in the last year. So we've now got 6 times as much investor assets under management as we had at this time last year. And this time last year we already had quite a bit. So it's getting better and better all the time. Right. So, Jonas, there's a question on leverage in open assets in our portfolio. You can actually, so the standard leverage on a Darwin is, the standard risk on a Darwin is 10% value at risk, which is about as risky as a risky stock. But you can leverage to invest twice as much without actually having to fund the position. So the leverage actually tells you how much you've borrowed to invest in the Darwins. If that doesn't clarify it, just send me if you can send me your email, I can take up contact with you to try and clarify the thing in more detail. So if you write down your email, I'll get back to you with a better explanation. Or if it's good enough, we leave it at that. Jonas. Because I can't see your email from here. If you could write it, Jonas, that would really be useful. Just write a question with your email in it. And for the rest of you guys, unless there's any questions, it's been a real pleasure, and there'll be more coming next week. As I said, next week we'll talk about the conditional orders, which is a pretty nifty addition to the whole thing. The conditional orders are initially only available on demo portfolios. We'll be testing them for the coming weeks, and once we're comfortable that they're both working as we expect them, and also we've done a better job of explaining them than we have today, then we'll release them to the live environment. Great stuff, guys. So thank you so much. I'll upload the recording into YouTube as usual, and you'll also receive a copy from GoToWebinar. So if there's any questions, that might be an additional way of finding out. Thank you so much. Take care, and I see you hopefully on our next webinar. Bye.